Okay, so today we're going to learn about Foundation 5, which is the last foundation of the 5 foundations. It's build wealth and give. To talk about building wealth and giving, you first have to build the wealth. So we have to talk about savings versus investing. When it comes to money, the terms saving and investing are a lot of times used interchangeably, but that is just not correct. Saving typically means if you're saving for something that you're going to spend that money in 0 to 5 years. If you're investing something, it means that you're not going to touch it for about 10 to 60 years. It just depends. Um, they both accumulate financial resources and are used to accomplish a specific objective, but those objectives take place over different time frames. So saving is more in the now and investing is more in the later. So saving versus investing. So saving, the process of putting cold hard cash aside to be used in the short term and on minimal notice, where investing is the process of putting money to work over a long term. Assets for savings would be cash, money, market accounts. Investing is more like stocks, bonds, mutual funds, and property. What can each of these be useful for? Well, savings can be useful for a purchase or an emergency, while investing is accumulating wealth for retirement. Usually when you put something away in a savings, you're only making about 0 to 2% on that. And when you're putting something away for investments, it's usually more like 6 to 10%. Warren Buffett lays this out in a really simple term. He said, investing is the process of laying out money now to receive more money in the future. So it's your money making you money. The difference is clear when you look at growth over time. So your money in your savings isn't going to grow as much as your money in your investments. And this is kind of just a quick little chart to show you that. If you start off these savings, your savings are only going to go up so much over time. However, your investing goes up a lot more over time because your return is higher. A slight catch though. In the investing world, the expected return you get can sometimes come at a risk. So there are certain risks when you invest money. It doesn't mean you invest money and then you always make money. You invest money and you make money, lose money, make money, lose money. It's kind of a back and forth scenario. There are different risk levels. Cash is the lowest risk, investing cash. Investing in bonds is pretty low. Your return's about 4.5%. Stocks, so investing in the stock market is pretty much in the middle. It's kind of medium. Because your stock market goes in cycles, so you might lose a lot, but another year you might make a lot. Your investment is really in return about 7.7%. And then you have U.S. microcap stocks, which are very high risk. Those are usually only done with people who work in investing, or if you have somebody who's doing your investing for you. The average person doesn't typically dabble in this. Even though their return is really high, 11.7%, it's also very risky. So what are some things you can invest in? Well, you can invest in bonds. A bond is a loan made to a large organization and it pays interest to the holder. So you give them money for a bond and they borrow your money. And then in a certain amount of time, you cash in the bond and they give you your money back plus interest. Mutual funds, this is a fund that may own multiple assets. So it might be a company that has a little bit of each stock, a little percent of each stock in a group of stocks that you put money into. A cash or equivalent is when you hold some cash and you can reduce risk and allow you to take advantage of new opportunities. So like keeping a portfolio of cash, that would be the way to do that. Stocks, obviously each stock is a share or a fraction of ownership of a company. So when you buy one share of Apple stock, you own a percentage of the company. So when they make a profit, your stock price goes up or down. If you bought a stock for $10 and the next day the stocks are worth $11, you have now made $1 for every stock you own. In the same respect, if you bought stocks at $10 and the next day they were only worth $5, you now have lost $5 for every stock. So that's when the market can go up and down. You can have hard assets as well. Real estate, gold, those kind of things tend to be physical assets that people buy and then make money off of later. Once you've made that money and your money is making you money and it sits for a long time because you don't touch it, you leave it alone for a long time in investing. Um, then when you're older and you want to retire, you are set in the way that you can then give back to charities or churches or struggling family members or scholarships or however you want to give. Randy Travis said this quote, "It's not what you take when you leave this world behind you, it's what you leave behind you when you go." And I think that's really important to know that you want to leave a legacy and help others as well. But you can't help others until you've helped yourself. So knowing that you need to build that wealth by saving and investing will help you in your future.